There's a system running the global economy. Not the stock market, not the banking system, not the Federal Reserve. It's called the petrodollar, and it controls everything from the price of oil at your gas station to the interest rate on your mortgage to why your grocery bill keeps going up even when you're doing everything right. Most people have never heard of it, and that's not an accident. For over 50 years, this system has been shaping the world. How governments borrow money, how wars get funded, why some countries get sanctioned into collapse and others never do. And it all traces back to one deal, made in secret in 1974, between the United States government and the Kingdom of Saudi Arabia. You were never supposed to think about this. Most people go their entire lives without ever connecting the dots. But once you understand how the petrodollar works, you'll understand why your dollar buys less every year, why inflation keeps coming back, and what's actually happening right now as countries around the world start quietly building alternatives to it. Let's get into it. Here's the thing most people get wrong about oil. They think about it the way they think about gasoline. Fill up the tank, maybe complain about the price, move on. But oil isn't just fuel. Oil is the raw material of modern civilization. The plastic in the device you're watching this on right now, oil. The fertilizer that grew the food on your table, oil. The synthetic fabric in your clothes, the asphalt on your roads, the chemicals in your cleaning products, the packaging around everything you buy, all of it starts with oil. In 2024, the world consumed roughly 102 million barrels of oil per day, every single day. Not just to move cars and planes, but to make, package, and ship almost everything that exists in a modern economy. But here's what that actually means for money, and this is where most people miss it. If every country in the world needs oil, and oil is priced in one specific currency, then every country in the world needs that currency. Not because they want it, because they have no choice. Whoever controls the currency that oil is priced in controls the most fundamental source of global demand for their money. That's not a metaphor, that's the actual mechanism. And for the last 50 years, that currency has been the US dollar. To understand how that happened and why it matters to the money in your bank account right now, we need to go back to the end of World War II. It's 1944. World War II is still happening, but 44 countries already know how it's going to end. So they gather in Bretton Woods, New Hampshire, and they make a decision about what the post-war financial world will look like. Their agreement? Every country ties their currency to the US dollar, and the dollar itself is tied to gold at $35 per ounce, fixed. The logic made sense at the time. The US emerged from World War II with its industry intact, its factories running, and about 70% of the world's monetary gold reserves. While Europe was rubble and Asia was rebuilding from scratch, America was the only economy that could anchor the global system. So the dollar became the world's reserve currency. Every country needed dollars to trade internationally, and the dollar was as good as gold, literally backed by it. Then came August 15, 1971. President Nixon went on national television, and in a 15-minute speech, he announced that the United States would no longer exchange dollars for gold. No international agreement, no warning to other countries. Treasury Secretary John Connally reportedly told foreign finance ministers, "The dollar is our currency, but it's your problem." Just like that, the gold standard was over. The dollar became what's called a fiat currency, government-issued money backed not by gold, but by trust and by the power of the U.S. economy. Most people hear this and think, okay, interesting history. What they don't realize is that removing the gold standard also removed the limit on how many dollars the U.S. could print. No gold reserves required, no ceiling, no constraint. That's the door that opened in 1971, and the petrodollar was what walked through it. But here's where it gets really interesting, because 2 years later, everything changed. 1973, the Arab oil-producing nations, led by Saudi Arabia, made a move that no one in Washington was prepared for. They cut oil production. They stopped selling oil to any country that had supported Israel in the Yom Kippur War. That list included the United States. Within weeks, the price of oil quadrupled, from around $3 per barrel to nearly $12. Gas lines stretched for miles. Inflation jumped. The U.S. economy, the most powerful in the world, was brought to its knees by countries turning off an oil pipe.
America suddenly understood something it had never seriously confronted. It was vulnerable, structurally vulnerable. And without a new anchor for the dollar, which had just lost its gold backing, that vulnerability could get much worse. In 1974, Secretary of State Henry Kissinger flew to Riyadh. The agreement was straightforward. Saudi Arabia would sell its oil in U.S. dollars. It would invest its surplus oil revenues into U.S. Treasury bonds and American financial instruments. In return, the United States would provide military equipment, security guarantees, and protection for the Saudi regime. Saudi King Faisal made one specific demand: that the scale of Saudi Treasury purchases remain secret. The U.S. Treasury agreed and hid Saudi holdings in regional groupings for decades. The actual numbers weren't disclosed publicly until a Freedom of Information Act request by Bloomberg News in 2016. The rest of OPEC followed within 2 years, because when the largest producer in the cartel sets the pricing currency, the others have no practical choice but to fall in line. This system, oil priced in dollars, surplus dollars recycled back into U.S. assets, is what we call the petrodollar. But here's the big idea, and this is what most people never put together. Here's what the petrodollar actually does. Imagine you're Japan. You don't produce much oil, but your entire economy runs on it. Your factories, your power plants, your shipping, all of it needs oil. To buy oil, you first need U.S. dollars. So Japan has to earn dollars or buy dollars or hold dollar reserves just to keep its economy running. And it's not just Japan. Germany, South Korea, India, Brazil, every industrialized economy on Earth. Every country that needs oil, which is every country, needs to hold U.S. dollars. That creates something economists call structural demand for the dollar. Not demand because people love dollars, demand because the global economy is architecturally wired to require them. And that demand gives the U.S. 3 massive advantages. First, it keeps the dollar strong. Because everyone needs it, there's always global demand for it. Second, it allows the U.S. government to borrow money cheaply. When the whole world is buying your currency, you can issue debt at lower interest rates than any other country on Earth. Third, it gives the U.S. enormous geopolitical leverage. Because so many international transactions run through U.S. banks, the U.S. can use financial sanctions to cut countries off from the global economy completely overnight. That's a power no other country has ever had in history, and it all flows from one thing: oil is priced in dollars. But here's the part that most people find hard to believe. What happens to all those oil dollars after they're spent? Most people imagine oil-producing countries sitting on mountains of cash. That's not how it works. When Saudi Arabia earns dollars from oil sales, those dollars don't sit in a vault in Riyadh. They get invested back into the United States. Saudi Arabia buys U.S. Treasury bonds. As of September 2024, Saudi Arabia held approximately $143.9 billion in U.S. Treasury securities alone, up $26.8 billion in a single year. The Gulf states invest in American companies, American real estate, American financial markets. Here's what that loop looks like. Countries around the world buy oil with dollars. Oil-producing countries earn those dollars. Oil-producing countries invest those dollars back into U.S. assets. That investment keeps the dollar strong and U.S. interest rates lower, which makes it cheaper for Americans to borrow, which cycles back into economic activity and then starts again. This is petrodollar recycling, and it's been running without interruption for 50 years. Here's the personal connection most people never make. All that foreign investment flowing into U.S. Treasury bonds suppresses American interest rates below where they'd otherwise be. Your mortgage rate, your car loan, your credit card APR, all of it is downstream of this recycling loop. Without petrodollar recycling propping up demand for U.S. debt, borrowing in America would be meaningfully more expensive. Every American with a mortgage has been living inside this system without ever knowing its name. But here's the question most people ask at this point, and the answer is more interesting than you'd expect. So here's the million-dollar question. If countries like Russia, Iran, Venezuela, countries that are openly hostile to the United States, understand this system and hate it, why are they still trading oil in dollars? The answer is infrastructure. Moving away from the petrodollar isn't just changing a payment method. It means dismantling 50 years of global financial plumbing, contracts, hedging systems, insurance, pricing benchmarks, banking relationships, all of it built around the dollar.
The US dollar has a level of liquidity no other currency can match. You can move hundreds of billions of dollars without crashing the market, and it has deep legal protections and institutions behind it. Most people think switching currencies is like switching apps on your phone. It's not. It's more like trying to rebuild the entire phone while it's still running in your hand. That's why even countries that despise the United States still use dollars when it's the most convenient option. China and Russia are not trying to eliminate the dollar overnight. They're doing something more strategic. They're reducing dollar use selectively, in the places where it hurts the US most. Russia, after Western sanctions in 2022, began settling oil transactions with China in yuan and rubles. China's yuan-denominated crude oil futures, launched in 2018, now account for roughly 10% of global crude trading volume. In 2023, China and Saudi Arabia completed their first yuan-denominated oil transaction. In early 2024, France, a G7 ally, finalized a yuan-denominated LNG deal with China. And then in June 2024, the original petrodollar agreement, the 50-year arrangement signed in 1974 between the US and Saudi Arabia, quietly expired without renewal. Saudi Arabia has not abandoned the dollar. Around 80% of global oil trade still settles in US dollars, but the direction of travel has changed. The dollar's share of global foreign exchange reserves has dropped from 73% in 2000 to approximately 57.7% in early 2025. Central banks worldwide bought over 1,000 metric tons of gold annually for 3 straight years, the fastest accumulation pace since World War I. China has slashed its U.S. Treasury holdings from $1.3 trillion in 2013 to roughly $682 billion by late 2025. This isn't a revolution. It's a gradual shift. But gradual shifts in 50-year systems have a way of accelerating when nobody's looking. So let's talk about what this actually means for you. Most people will hear everything I just explained and file it under interesting but abstract, something that happens between governments and central banks, far away from their paycheck and their savings account. That's the most expensive mistake you can make. Here's why. If the structural demand for US dollars starts to erode, even slowly, even gradually, the consequences don't show up as a crash. They show up as persistent inflation, higher interest rates, a dollar that buys less over time, exactly the conditions that most Americans have been living through since 2021. The dollar has already lost over 87% of its purchasing power since 1971. Since just 2020, cumulative inflation in the U.S. has been approximately 23%. A basket of goods that cost $100 in January 2020 costs about $123 today. That's not just the economy being bad. That's the cost of a monetary system that allowed more money to be created than any other country in history could get away with, because the world had to absorb those extra dollars to buy oil. Most people will go the next 10 years doing what they've always done, keeping the majority of their wealth in dollar-denominated savings, dollar-denominated bonds, dollar-denominated retirement accounts, fully exposed to whatever happens to the dollar's reserve status. People who understand this system will do something different. Not panic, not sell everything, not move to a bunker, but deliberately position a portion of their wealth in assets that don't depend on the dollar staying dominant. Gold, which has been a store of value across 5 millennia and every regime change. Real assets, international diversification, things that hold value when the currency they're denominated in weakens. In 10 years, these two groups of people could have very different financial realities. Not because of income, not because of luck, because one group understood the system they were operating inside. Most people were never told how this works. Now you have been. The petrodollar has survived for 50 years, through oil crises, through recessions, through wars, through the collapse of the Soviet Union, through 9/11, through 2008. It will survive for longer. But something is different now. The original agreement has expired. The countries that built alternatives are building faster. And the data from the IMF, from central bank balance sheets, from the direction of oil contracts, tells a story that isn't speculative anymore. The question isn't whether this system eventually changes. History says it will. The question is what you do with the time between now and then.